Investors in the markets uh, can never escape tax. You know, you have to pay your tax when you sell your shares. It could be capital gain tax. It could be any other kind of tax, but there's no how a typical investor can escape tax. So in this video, I want to consider how tax reform and corporate tax changes, and corporate tax changes impact stock market or impact stock prices. You discover that whenever there's tax reform by the government, and whenever there's that changes in corporate tax, these factors will certainly affect stock prices. And so look at number one. Number one is impact on corporate profit. That's how does tax impact corporate profit. So in this case, we are considering lower corporate taxes. Lower corporate taxes. Tax cuts for corporations increases after tax profits, often leading to higher stock prices as investors expect improved earnings. If companies are taxed less, the savings in tax will certainly boost their bottom line, and that would increase earnings. Increase in earning will certainly result in increase in markets and in stock prices. And so companies may reinvest savings into expansion, research, or dividend payouts, which will certainly boost stock valuations. We have here corporate tax, higher corporate taxes. We've considered the lower corporate taxes. We also want to look at higher corporate taxes. So conversely, tax hike reduces net profits, leading to lower stock prices as investors adjust expectations for future earnings. Increased tax burden, can also lead companies to cut costs in order to be able to increase their bottom line or to see how they could mitigate the impact of these higher tax rates, on their earnings. And so, lower tax rate will increase profits, while higher tax rates will then decrease profits, will decrease earnings. Let's take, for instance, a company earns maybe, let's say, a profit of $10 billion, and it is taxed at 20% tax rate. That means that it is going to give out, you know, uh, uh, $2 billion as tax. But if it is taxed at maybe 10%, it will only give out, $1 billion as tax. So that's that $1 billion difference will go directly into the company's profits, and that would boost its earnings. Number two is changes to dividend payouts. Changes to dividend payouts. So tax cuts actually could equally affect dividends. Dividend may experience tax cuts. If tax reforms lowers taxes on dividend income, it can make dividend paying stocks more attractive. And it could equally lead to increased demand and higher stock prices for companies with strong dividend history. If there's a cut in dividends, if there's a cut in tax on dividend payout, you discover that particular action will attract investors into dividend paying stock because they are fully aware that that dividend will not be taxed at a higher rate. Under number two, still the other subheading here is dividend tax hike. If you consider dividend tax cuts, we want to consider dividend tax hikes. In this circumstance, discover that an increase in dividend taxes can make dividend paying stocks less attractive, to income-focused investors, potentially leading to a decrease in their stock prices. Because it is less attractive, investors will sell their positions, and new investors will not come in, to buy, and the price will naturally go down. Number three is investor sentiments and market reaction. Investor sentiments and market reaction. And in an atmosphere of positive tax reform, we discover that markets often react positively to tax reforms that reduces corporate taxes, viewing them as a signal of economic growth as well as business-friendly policies. And the stock price generally rise due to the expectation of increased corporate earnings and economic expansion. And whenever investors expect corporate earnings to increase as a result of a kind of lower tax rates. You discover that stock prices will do very well, will perform very well. And you equally have a negative tax reform. So if tax changes are seen as unfavorable to businesses, or leads to economic uncertainty, stock prices may fall, as some investors adjust their expectations. So the market is governed by not only action, but by expectation, because investors most of the times react proactively before the event itself takes effect. Investors have either sold or buy additional shares, depending on the outcome or the expected outcome of government policies in this regards, tax policies in this regards. Please like this video and subscribe to this channel if you've not done that. Number 4 is effect on stock valuation. Effect on stock valuation. You would have come to understand that lower taxes would certainly boost valuation. Lower taxes improve the earning potentials of companies, which can drive their price earning ratios. So investors are willing to pay more for shares of companies that will benefit from tax cuts. If they expect that a particular company or companies or sectors will benefit from tax cut, investors will buy the shares proactively, expecting that at the end of the day there will be an increase in earning that will then cause the stock price to increase as well. So higher tax, reduces valuation, just like lower tax boosts valuation. Higher taxes reduce valuation. So higher corporate taxes can reduce earning growth, certainly, leading to lower valuation. The increase in tax cuts in tax costs, can make companies less competitive and lower their long-term growth prospects, affecting the stock prices. So tax is critical when it comes to corporate earnings. So whenever there's an increase in taxes, it will certainly, affect stock prices, because it definitely eats into the earnings of the company. And once earnings, are like affected, then that will cause investors to sell off their positions and probably quit the market. Number 5 is sector-specific effects. We will observe how tax changes or tax cuts or tax reduction or increase in taxes affects the entire market. We want to see how it could equally impact specific sectors or specific industries within the stock market. So industries with high tax burden, we want to see exactly what happens to industries that have the misfortune of carrying high tax burden. You discover that some sectors like utilities, or capital intensive industries are more sensitive to tax changes. Tax cuts can significantly improve their profitability, leading to stronger stock price performance, in these sectors. Whichever sectors, happens to experience, a lower tax rate or tax cut, that sector will perform very well. The stock prices will respond accordingly. And so we equally want to consider global companies. So multinational corporations that benefit from tax reform, such as repatriating foreign earnings at lower tax rate, may see their stock price rise as a result of increased cash flow and potential reinvestment. When companies invest in other countries like multinationals, and usually, apart from reinvesting their returns in the country they've invested in, they may equally repatriate profit back to their country. And so if those profits are like taxed at a lower rate, that would boost the stock price. But if they're taxed at a higher rate, and it might have a negative impact on the stock price of such companies. In conclusion, tax reforms and changes to corporate tax policies directly impacts stock prices by influencing corporate profitability and investor sentiments, as well as a market valuation. In a case where you have higher tax rate would eat into profits, and of course that will affect earnings. And once earnings take a hit, discover that investors will then sell off their positions and the stock price will go down. In a case where it's a tax cut generally increase company corporate profits, and once there's an increase in corporate profits and earnings, that will attract investors to the company. And once investors buy the company's shares, and then you discover that the stock price will increase. So that's how our tax reforms as well as uh, corporate uh, corporate tax changes affect stock prices.